Well, good afternoon, everyone. Welcome to the next series of the Super Update. So what's been happening with Inside Super in the last quarter? So effectively between April to now, it's been a reasonable busy time. Obviously the budget's sitting in there. So there's a little bit to talk about this morning, or this afternoon I should say. So we'll get straight into it. There's still a few people that are still to join, but I think we'll get going in respect of those who have turned up. So firstly, just to cover off, obviously the general advice warning, since superannuation is a financial product. So while you can trust what I'm saying, you just actually can't believe it unless you talk to me specifically about it. So what we're going to talk about today, the accountant exemption in relation to where that's sort of sitting, the federal budget announcements from the budget that's just passed in May, and also a little bit of an update as to the announcements that were made in the previous federal budget and where they're sort of sitting. We'll quickly talk about the self-managed super fund approved auditor regime, some draft regulations that hit the desk late last week. We'll look at the differences in the final limited recourse borrowing arrangement ruling that the ATO issued about 2 weeks ago. A bit of an update about when a pension starts and stops ATO ruling. The tax office have also issued the self-managed super fund annual return for 2012, so I'll have a little quick glimpse at that. Briefly on the GST on residential properties, some things that self-managed super fund trustees should just be aware of. Some update on the Super Seeker website, and just to sort of make you aware of it if you're not already. A couple of things the ATO are looking at, just broadly, look at some contribution reserving and how that may be applicable, particularly this time of year. We'll look at some compliance and more specifically some AAT cases that have been handed down, and just some things just to be aware of coming into the before the 30th of June. So, with all that, let's get going. The accountant's exemption. Most of you will be aware that this has sort of been an ongoing issue for almost 2 years now, since they said that yes, they're going to get rid of the accountant's exemption. Now, the closest we've come to date is a recent comment that was made by a senior Treasury official at the Senate Estimates Committee hearings that have been going on down in Canberra at the moment. And basically, he made the comment that it was the government's intention to move the licensing regime into FOFA. So basically, if you're talking to clients about self-managed super funds, that includes the setup and so forth, setup, wind up, and everything else, you will need to be licensed. So you'll either need to obtain your own financial services license or become part of a broader dealer group and become an authorised representative of that licensee. Now, at this stage, look, we don't know what sort of form that's likely to take. It could be a specific license that accountants are able to obtain, so they don't have to go through the whole rigmarole of the normal financial services regime. But at this stage, that's where it sits. Also, I should make mention too that there's draft regulations that are about for advising in limited recourse borrowing arrangements, that from 1 July 2012, any party that is involved in these arrangements will actually need to have a securities or derivatives license or authorised representative under a licensee. So that means you have to be an authorised rep not only for superannuation but also for securities or derivatives. And the reason why that is that technically a limited recourse loan arrangement under the asset guidelines is a derivative product. So once again, this has been kicking around for a couple of years. It's the second draft ruling we've seen on that arrangement, and it's still not finalised. But to be safe, you probably should make sure that you've got that licensing requirements. There's a number of providers out there that you can probably achieve that, even though it's only 3 weeks away. So that's just something to be aware of, because you want to make sure that you've got yourself covered there, because if it goes wrong, then you'll potentially have no PI cover. As far as the budget 2012, I'm sure we've all heard this verbatim, but just in relation to the couple of things that came from it for super, contributions tax increases to 30%, so not just the 15, but up to 30% for those who are earning an adjusted taxable income of $300,000. Now that does include your superannuation contributions, but it is only on the contributions that sort of put you above the $300,000 if that was the case. Essentially, for those that are old enough, back in going back to 2006 days, this is essentially a surcharge. The old surcharge tax regime has been reborn, except they've done it a different way. It probably would have been far simpler and easier for the industry if they would have just put a recommencement date on that original surcharge legislation, because that provision would have been available to them. But in the end, they've decided to reinvent the wheel. Needless to say that no matter which way they would have done it, it's still bad policy. And they've also introduced a low super contribution of $500. So the way that works is similar to the co-contribution, insofar as the government's giving you money, but it operates slightly differently. So this is for employees who have their super go, the super goes into a super fund, and if they earn less than $37,000 a year, the government effectively is giving them a rebate of the tax that's paid by their super fund. So, if they're and that $500 is actually 9% of $37,000, the tax component of it. So that way, those who are earning less than $37,000 effectively pay no tax inside their super. That's in essence the nature of the measure. The $37,000 is the same threshold as the government co-contribution, and the reason why they're doing this rather than the co-contribution is that primarily the co-contribution was only taken up by those that had spouses that earned more than $150,000. So they're trying to avoid that situation where it's more for general, genuine low-income earners. And lastly, the other, I suppose, major announcement from the budget from a super point of view was the pausing of the indexation for concessional contribution caps. So now we won't see anything until the 2014 year. It should have actually happened in the 2013 year, but now we're essentially 2 years down the track. Remembering that the indexation is to a wattie, the average weekly ordinary time earnings, but it had to go up in $5,000 increments. So next year we should have had a $30,000 contribution cap, but in the last budget they paused that, and they've paused it again. And the reason why they're doing that is essentially to move the deck chairs from one type of taxed environment into another, or to help the government get back into surplus. And the bill for that is actually before the House of Reps. It's held in the third reading, so presumably it won't be long before that receives royal assent. Excessive contributions tax refund. This is a bit of an update from the previous budget, because yes, there are still a number of things that haven't happened. Once again, this is before the House of Reps. In fact, these are all in the same budget. The same bill, the Tax and Super Laws Amendment. And this, you may remember that this is where if you exceed your contribution cap by up to $10,000, you're able to actually get that refunded out of super to you personally, and you pay tax on it at your marginal rate. So if you're on top marginal tax rate, it's going to make no difference if it stays in super or not. If you're on a lower tax rate, well then it'll be more advantageous for you. Bearing in mind that the $10,000, it's a one-time, 1 year, one hit type deal. So if you had $2 worth of excessive contributions and you don't use this, you can't use it again. You've got to use it for that $2. If you have $10,001, you can't use the measure and you can't actually ever use it again. So it's very limited and only in very specific circumstances. Super on pay slips, once again from the previous budget, this in the same bill as the one mentioned before. It's in the House of Reps, so that will become a requirement. I think that's for the 2013 financial year. And an update on the SMSF regulation, which is all part of initially it came from the Cooper review into super, which then the government made a response to via their stronger super back in November, December 2010. Then they made these announcements in the budget, which was May 2011. And as you can see, the ATO administrative penalties, there's been no progress on that one. The banning of off-market transfers, no progress on that one. The tightening of restrictions on personal use assets, yeah, they actually did that one, so there's a tick there. And the reason for that is that they only had to change the regulations of SIS to do that. So the change the regs means it doesn't need to actually go through Parliament. So that's why a lot of what they're doing now is making the legislation, which gets passed through Parliament, refer to the regulations, which doesn't have to. So it's a lot easier for the ATO and the government to basically get their changes of super through. And finally, the last one there, which is the valuation of super fund assets at net market value. Last week, I think it was, we received some draft regulations on that, and we'll talk about that a bit more specifically in a minute. Now, just moving on to the approved SMSF auditors. There's been a little bit of movement in this station. Essentially, ASIC is going to form a register of auditors, and they all have to be required to comply with certain competency standards. There'll be an exam to sit, and independence requirements. Now, the independence requirements are basically the same as AP ES 110, so you have to refer back to your accounting body's policy statements there. Basically, this will start from 1 July 2013, and to be able to register as an approved auditor from 31 January next year. Well, that's the plan anyway. Now, as the auditor that we use has made the flippant comment that he actually needs to be more qualified than the auditor of BHP, because the auditor of BHP needs to be a company registered auditor, where he's that already, but now he also has to do this as well as become a tax agent, and because of the requirements of his accounting body and things like that. So there's still a little bit of animosity towards this arrangement, but unfortunately, I think it's a grin and bear it. And there will also be a fee to be a registered super fund auditor, and we don't know what that is yet. In fact, in the Senate Select Committee hearings at the moment, they're all talking about the levies and so forth that are being proposed, more specifically around the stronger super and how that's going to be paid for, because it's costing a little bit more than what they expected, funnily enough. Just touching on those draft regulations that I referred to. So the valuation of super fund assets. Now, it's been, I suppose, fairly common that most accountants and administrators of self-managed funds actually do use market value for the assets in the funds, but there's nowhere where that's actually required in the legislation. Back in about 2004, if I remember correctly, 2005, the tax office issued a ruling that referred to you had to use market value if you were commencing a pension, but that was for RBL purposes. Now, of course, RBLs died a death in 2007, so in reality there was no real need to do it. There's been comments from the ATO that if you're starting pensions or things like that, then you still should revalue assets, but it really wasn't, there's no compulsion to do it. Well, now they're making that a compulsion. And what they're actually saying is that you'll have to use market value less transaction costs in accordance with AAS 25. Now, AAS 25 is the accounting standard that's used for the big APRA funds. Interestingly, AAS 25 has been around since I think about 1993, and it's actually in the process of being rewritten. There's actually an exposure standard kicking around, and that uses the notion of fair value. Now, those who are up on their accounting standards, that incorporates a little bit more, and we still really don't know what this is going to mean because there's no detail on the requirements for valuations by the tax office on things like property. They refer to transaction costs in the draft regs. Now, does that mean that you have to take into account brokerage on the sale of your shares? So rather than just picking up the market value of the shares, do you then have to pick up, say, a 1% brokerage on the sale? In theory, that's a transaction cost, so yes, you would. For your property value, you've got to then pick up the potential or estimate your agent's costs and on-costs for selling a property. We do that one anyway already, but yeah, there's still a lot more detail that needs to be fleshed out about that particular draft regulation. Sorry. Another little interesting one is the separation of assets. Now, currently under SIS under 52.2D, it requires trustees to keep their assets separate. But that's a real problematic one for the tax office because all they can really do is use it as a weight of evidence against the trustees for saying that they're not using the fund for the sole purpose of retirement benefits. So in other words, reel out the big stick and say we're going to make you non-complying. What this regulation will actually do is they're changing it to an operating standard. So now the tax office can impose fines. So basically, fines of up to $11,000 if you don't have the assets in the right name of the fund and you don't treat the assets correctly. So that's going to be a big one. And no doubt the auditors will be required to focus on that a little bit more. And that will also mean that the tax office will probably be using it as a bit of a windfall to fund their compliance obligations. Not that I'm suspicious or sceptical. Investment and insurance strategy. Now, as part of this draft regulation, they will require the trustees, as part of their investment strategy, to also consider insurance. Now, that's an interesting one because now they have to basically consider offering insurance to members because remember, trustees and members are very separate people in the world of SIS compliance. And presumably then there's going to have to be some reference to or customisation specifically to if the members are in pension phase, their ages, that sort of thing. So it's really going to have to deal with that quite specifically. And the other thing is that the investment strategy needs to be reviewed regularly. Now, this notion of being reviewed, it's already in the investment strategy, the requirements, but the notion of being regularly reviewed changes that potentially. So how often's regular? Well, how long's a piece of string? Is it annual? Is that regular? Is it quarterly, weekly, monthly? Who knows? Ultimately, that'll be a judgment decision for the administrators out there, for those who are doing that on behalf of their trustees. Some trustees, actually will do it all properly, but most it's done by the accountant or the administrator. So that'll be something that you'll just need to consider as part of your service offering, essentially. Moving on to limited recourse borrowing arrangements. The tax office have finalised their ruling. So this is now SMSFR 2012/1. Now, essentially, it's much the same as what they released in the draft, which is good because industry was pretty happy with what was already there. Now, there's a couple of slight differences or variations though. There's this new factor they've introduced when considering a single acquirable asset, and that's a unifying physical object. So essentially something that's of a permanent nature and is not easily removed, and it's significant to the value relative to the value of the asset. So in other words, a big property, say a big building on a piece of land, or it might be a very large shed. It can't be like a little corner slab somewhere that sits over the two titles. So they're trying to, I suppose, define a bit more exactly what makes a single acquirable asset, where you have essentially two assets where it essentially makes it one. And they also introduced further clarification on when an asset becomes a different asset. So as far as repairs and maintenance versus improvements, that sort of thing. And there was no changes to that whole notion. But what they've done is that they've used terms like superior materials, substantial alterations, minor and trifling, broadly comparable. So they've introduced all these, I suppose, wishy-washy variables that help try and define a bit more what it is. They've brought in a couple of more examples, and they've also brought in a bit more clarity around the arrangements where you have a house and land package, that sort of thing. So basically, it's very much a case by case, and the sensible approach would be to look at that draft rule, or look at this ruling every time you have a client that says, "Hey, I want to buy this property." Run through the examples and make sure you document down the reasons why if they can or can't do it, and then you'll be fine. Now, you may remember the draft ruling about when a pension starts and stops. Now, they copped a fair bit of flack over this one, to say the least. Now, this final ruling has actually been due several weeks now. Every week, the ATO say, "Hey, this is what we'll be issuing next week," and it just keeps on returning. So basically, we've just heard crickets on this one, just silence. So hopefully, we will have a definitive answer on that relatively soon, bearing in mind that the original draft ruling was retrospective back to 2007. So there's some water to still run under that bridge, I feel. Now just touching on the 2012 SMSF annual return. I always get excited when the new tax returns come out, which I suppose says a fair bit about me, really. Now, there's not a lot of change in the return this year as compared to last year, although I did find it interesting that Stuart Forsyth, the Commissioner in charge of the super area, made the comment down at in February down at the Spark National Conference that I attended, that every time they change a line item on a tax return, it costs them about $2 million. When I say them, the tax office. So not something they generally do lightly. So they essentially have to put forward a business case as to why they want the changes made. So what we have is a little bit of movement on some of the labels. So the exempt pension income has now come out of the general expenses area, and it's moved to just below the income but before expenses. So it sits separately. No doubt that's for them so they can just analyse what's going on a bit more. As far as Section D, the income tax calcs, they now have a tax on taxable income before no tax file number tax applied, and credits and offsets have been grouped based on whether they're refundable to the fund or not. So just a couple of minor movements. A couple of new labels. We now have an administrative expenses label, administration expenses. Previously we had administration and management expenses in one label. They've now split those apart. And also in the compliance area of the tax return near the back, we have a new label that says acquisition of exempt assets from related parties. And finally, in the budget they did say that the levy would increase but didn't know how much. Well, lo and behold, we found that out in the draft, or in the tax return, where it was populated at $200. So there is now a $20 increase in the levy. Bearing in mind that in the last budget, last year, that the levy increased from I think it was 35 or 45, up to $180. So essentially in 2 years we've seen the levy go from 45 up to 200. So that's a pretty big jump. Just moving on quickly to GST on new residential properties. This legislation came in on the 21st of March. Basically, sales by developers of residential premises constructed under certain arrangements, called development and lease arrangements, will now be taxable supplies. So they're just trying to pick up more GST revenue, essentially. So just something to be aware of. And data and e-commerce standard. This is all part of the stronger super regime. there's a new data standard that basically means that all self-managed super funds will have to process rollovers and accept contributions under the new standard. Now, this is all part of the more efficient back-end stuff. So that is the super fund's bank account will need to accept EFT transactions. So it can't have a passbook anymore, and yes, there are still those that do. And the rollover processing will need to be done electronically. Now, this is very interesting because there's pretty decent fines for super funds and or administrators that don't comply with these arrangements. So either your software provider, which will hopefully do it for us, or an intermediary will play a part in this. So, and if you're rolling into a new super fund or even an existing one, there'll need to be a mechanism by which the APRA fund can electronically transfer the data into the self-managed fund. So like I said, I know there's a couple of intermediaries that are working on this at the moment that will then try and plug into software. And probably some of the software providers are also working on this to formulate their own strategy. But you know, potentially this is a real issue for the self-managed super fund market, given the fact that there's so many of them spread so vastly across the country, you know, across accountants and administrators. Not to mention those trustees that do everything themselves, and there are about I think 35, somewhere between 10 to 35,000 that actually do that, according to the Cooper Review. The Super Seeker information on the ATO website. I thought I'd just bring this to your attention. There's a couple of reasons. One is you may not actually be aware that it exists. Now, basically, the Super Seeker website allows, I suppose, more specifically individuals to log in to a website to find their lost super. So that's a great thing. Now, all you need to do that is basically your tax file number and your date of birth and your name. And you can log in and see your any lost super that you have. So you've been able to do that for a little while now. Well, what they've done is they've made it, they've improved it a heck of a lot, and now a member can actually see all of their, or sorry, an individual can actually see all of their super, both inactive and active. So you log into the first part, and on the right-hand side it actually says My Super. You click on that, and then you have to put in a lot more information, a lot more detail about what you need to log in. Now, essentially, they give you a range of bits of paper that you need to provide. So notice of assessment or a super account statement for the past 5 years, as well as a PAYG payment summary or something like that. So there's a little list there. And obviously it tells you on the website. So once you do that, you actually get a login. So then you can log in at a secure login that you can log in at any time and look at your super. And that will allow you to see your super funds, all of them that have reported a member benefit or member balance, as well as the balance, so the actual dollar amount there. So it's a fantastic initiative. And I only wish they would open it up to administrators, tax agents and the like. But at the moment, you actually can only do it as an individual. The privacy statement on the front is very clear about that. They have a mechanism in which third parties can access the lost super regime through a thing called Super Match, and you have to basically fill out a form and send that off to the tax office as to why you want to do that. But as far as all that beautiful extra information that would help particularly financial planners in consolidating super, you can't actually obtain that information without the client sitting with you. And given the fact that the tax office could search IP addresses and all that sort of stuff, I would strongly recommend that you make a file note that if you're doing it at your premises, the client is with you and they also just sign that file note. So that way if the tax office ever come questioning, you can say, hey, they were here and here's the evidence for that. A couple of things on the ATO's radar. Early access to super, it's sort of been there for the past few years. there's a lot of more scrutiny about that. We've also seen a higher increase in ATO compliance just generally, particularly on the back of any audit contravention reports that have been lodged. There's been a few recent cases where they've prosecuted trustees, some of those we spoke about last time, and obviously there's some big fines there. So up to $220,000 for a corporate trustee. So just do something for them to be aware of. Proportioning rules. So if members are taking benefits, pensions particularly, and also rollovers, that sort of thing, the tax office have realised that, particularly with processing pension payments, that perhaps they're not being proportioned correctly when the withdrawal is made. So even though they're taking a pension, you need to make sure that you're proportionally taking a taxable and tax-free portion of that pension. And also, obviously, there's a bit of heightened scrutiny about the director's liability, just in relation to superannuation payments. Now, I thought I'd just quickly mention contribution reserves. This has received a bit of press of late because of a recent ATO ID, 2012/16, in which I think it was Cavendish out of South Australia, a reasonably large administrative firm down there, put forward a ruling, a question to the tax office and said, right, this is the scenario, can we reserve the contribution? Because the legislation has always, or since 2005, I think it was, or 2006, sorry, when they brought in the notion that contributions had to be allocated within 28 days following the end of month. So that is, if a contribution was made in June, it had to be allocated by the 20th of July. If a contribution was made, say, the end of April, or in April, it had to be allocated to the member's account by the 28th of May. Now, so that's been around for quite some time, but it's become, I suppose, a bit more topical, a bit more relevant as the contribution caps have been dropping. So now that we're down to 25,000, and particularly with the surcharge and all that sort of thing, the tax on the higher income earners' contributions, this, I suppose, idea or this notion has been getting a little bit of play. So essentially, if the trust deed allows, and that is a big thing, then a contribution that is made in June can actually be received in June, a tax deduction allowed to the person making or the entity making the contribution in June. However, for contribution cap purposes, it's not allocated to the member until July. Now, the ruling actually doesn't refer to it as a reserve account. It refers to it as a contribution holding account. Now, in reality, it is a reserve account. So if your trust deed allows for reserving, then you'll be able to do this. If your trust deed says that a contribution must be allocated to the member's account immediately, then you won't be able to do this. So it's important to look at your trust deed. A little bit of an example. So, and this is actually straight from the ID. So if a 25,000 personal contribution was made on the 4th of April, and it was allocated to the member, all right. So 25,000 into the fund, allocated to the member, we're all good. Then a further contribution was made on the 28th of June in the same year of $25,000. However, it was not allocated to the member, so it was put into that contributions holding account or into a reserve account. On the 4th of July, that June contribution was then allocated. So the 4th of July is within 28 days following 30 June, so that's fine, it all complies with that. Now basically the tax office said, yep, look, that's fine, and what it also means is that a tax deduction of $50,000 will be available in 2011, and the $25,000 allocation that happened in 2011, being the 4th of April contribution, is reported in the tax return under the members section there in the MCS member contribution statement of 25,000, and the 25,000 that was allocated in the next financial year, so in July, that's put on the 2012 MCS. So hence there's no breach of the contribution caps. So that's a great thing if you've got clients that want to put money in sooner. So rather than wait until July, they can do it now, get the tax deduction now. Perhaps they've made a capital gain on an asset. Good luck to them. In the 2012 year, so then they can actually put a little bit more in and get the tax deduction and not have to, potentially have more tax issues. The downside, though, as with any sort of prepayment, you can't actually make another contribution into super until June next year. So, and then that will have to be reserved because you've already used your 2013 contribution. So effectively, once you start the process, then you have to keep on reserving that contribution every year until you no longer make a contribution into super or no longer eligible to. So it's something that you just need to really consider, because if your client situation changes and they say they were self-employed, they used the reserving strategy, then they went and got a job as a wage and salary earner, their employer then started putting in contributions into super, those SGC contributions will be excessive. So you've really got to, I suppose, understand your client's circumstances to make sure that they don't get hit with extra tax. A little bit of an update on the compliance side of things for some cases. So Allen's Asphalt, you may remember we spoke about this last time. For those that joined us, essentially in this case, it was where a transaction in a family trust was then distributed to a unit trust, which was owned by a super fund. So a very large capital gain went from a related family trust into a unit trust into the super fund. And the tax office basically said, no, look, you can't do that. That's special income, or sorry, non-arm's length income, as the rewrite says. And what that means is it's taxed at top marginal tax rate. So from memory, this is about a $2.5 million capital gain, and you will need to, and it was taxed at top marginal tax rate. So the ATO have come out with a decision, impact statement, just saying, yeah, well, look, we agree with the full federal court, and they have then they tried to seek appeal to the High Court, but that was denied. So yeah, unfortunately, I suppose it's a fairly straight, clear-cut case, but that's what happened. Now I've just had a question come through here just about financial services and the investment strategy, where they've asked, do you actually need to be licensed to do a draft investment strategy for the fund? I'm aware that we can't, or shouldn't rather, because it's providing advice. Look, the danger with preparing an investment strategy for a client on their behalf is that it's all about perceived advice. So if you were to prepare an investment strategy that has ranges in it, then the client could very easily come back and say, well, you actually populated the range, the asset allocation for me. That asset allocation failed, and you needed a license to actually give me that asset allocation. So you're in breach of the financial services licensing regime. So yes, you do need a license to actually do asset allocation. Now that means for that purpose you need a generic and a superannuation authorisation to do it. To give you a little bit of insight on what we do, we actually quite clearly, I suppose, articulate that the investment strategy is being made on the basis of the previous financial year's financial statements, and it's merely to comply with the legislation, and we don't actually populate ranges. So we actually get the trustees to fill out ranges. And if they ask, then we talk to them about, because I'm obviously authorised, so I talk to them about how they need to formulate those ranges. So you need to be, I suppose, quite careful in that regard. So hopefully, Benjamin, that sort of answered your question there. Another case, which is an Inner Health Energies Proprietary Limited. This is where the full federal court ordered the trustees pay compound interest on an amount that was outstanding. So essentially the fund was found to be in breach of a particular transaction, and they had entered into an enforceable undertaking with the tax office, and they didn't do that in as fast a timely manner as what the tax office wanted them to. So essentially it went to the federal court, and the ATO won by saying that they had to pay compound interest. So just something to bear in mind there. Recent AAT case essentially upheld the tax office's view in a paper they put out. I think it was 2009 or 2010. I think the draft ruling was 9 and the final ruling was 10, just on when a contribution is made. So in this case, a cheque for a contribution was posted to the employer on the 28th of June, but it wasn't actually received by the fund until the 5th of July. Now, the ATO ruling basically says that the contribution is deemed to be for the financial year in which it's received. So as it was received in the 2008 financial year, that's when it was processed. So in this particular case, this was for a special circumstance for a contribution, excessive contribution matter, and the individual lost because it was found, or basically the AAT said the cheque was received in the 2008 financial year. It's not special because you knew it was happening. So unfortunately, it's excessive. Super fund breaches of the early release conditions. Now, the tax office have been taking a little bit of an interesting slant on this, where they're basically saying that they've been accessing it at their individuals' ordinary tax rates. So rather than penalising the fund per se, they're going after the individual who received the money and saying, hey, you've got to pay that your normal marginal tax rate. And in this case, it basically confirms that, where the Mason pulled out $20,000 for himself without satisfying a condition of release, and the commissioner hit him up with that as income, as ordinary earnings, and the AAT basically upheld that decision and said, yep, that was right, and the ATO should not have allowed for concessional tax rates. So I suppose the AAT have sort of confirmed the ATO's approach on that at the moment. And moving into the final stages, which I'm sure you'll all be glad to hear, just some year-end issues that you may need to consider. Now, the contribution caps, they're being reduced for everyone from 1 July next year. So, 1 July 2012, I'll get that correct. Keep on saying next year as the next financial year. So the reduction in the caps for those over 50, currently that will go from $50,000 down to $25,000. So everyone will be on $25,000 contribution caps. And the I suppose the reserving, being mindful of that as a possible strategy. Removal of, I should have also mentioned that removal of the upper age limit for SGC contributions from 1 July 2013. So even though that was passed in Parliament late last year, you may remember there was some issues about the way the legislation was actually written. That actually doesn't apply until July 13. Limited recourse borrowing arrangements, don't discount that as an avenue to get more money into super, particularly while we're still able to do in-specie transfers. I've got a few arrangements at the moment where clients are doing in-specie transfers of their shares using limited recourse borrowing arrangements because they have very large parcels of shares outside that they want to put inside the super environment. So remember to use that as a bit of a strategy if you have clients that sort of have that ability. Make sure that your clients are actually taking their minimum and maximum pensions. So bearing in mind that if you fail to meet the minimum pension standard or you exceed the maximum pension that's available, then basically the pension will be ceasing during that year. So they will lose the exempt pension income deduction that they may have otherwise received. So it's very important that you ensure that your clients meet their minimum pension requirements. In fact, at the moment, we're sending out some reminder schedules to all our pensioners to say, hey, don't forget to take your pensions. So just bear that in mind. And also the new standards about collectibles and personal super assets. They apply from 1 July 2011. So if any of your clients buy new collectibles, so artwork, that sort of thing, there's a whole new regime that they need to comply to. They need to have reasons why it's stored in particular places and all that sort of thing. So as you're getting through the fund, they have to have all this in place, including insurance and so on and so forth. Otherwise, it's actually a fine and potential breach. So just something to bear in mind, that if you know clients have gone into the personal use assets, that they actually have all this covered off. And finally, just some the updates of the rates and thresholds. So for contribution caps, as I've already mentioned, $25,000 for everyone, regardless of how old you are. Back in the 2011 budget, they said that they were going to increase the contribution cap to $50,000 for those people who are over 50 but have less than $500,000 in super. Well, essentially that all got a bit hard. We haven't seen any legislation, and they've pushed that out now until next year. So whether we actually see that, it will be another question, but we'll wait and see. What it does mean, though, is there's no change to the non-concessional limits or caps of $150,000, and for those under those under 65, that is now $450,000 bring forward. So that still is all the case. For 2013 financial year, there is a reduction of the drawdown requirements of 25% again because of the global financial crisis that seems to be continuing to roll on. So that applies for 2013. At this stage, it's proposed that by 2014 we'll be back to normal. But given the current state of play in world financial markets, we'll wait and see where that one goes. Just the indexation of some of the caps and have come through. So your tax-free redundancy is now $175,000. Your minimum contribution base for your SGC has increased. Your CGT cap, your untaxed plan cap, and also just bearing in mind that low-income superannuation contribution co-contribution, that there's a freeze on that on the indexation there, and also the freeze of how much the government have given you. So potentially I see the co-contribution dying a bit of a death, and the new measure, which is the tax being paid or rebated, I should say, on contributions made for people who are under $37,000, I think that will basically become the new regime. And essentially, that's all I have. So there's a fair bit of material. I know I've covered it with a bit of speed, but I just wanted to make sure that we got everything in. And look, by all means, if you have any further questions, feel free to shoot them through. Otherwise, I'll say thank you for listening, and hopefully we can catch up in 3 months' time. So if there's any questions, doesn't look like it. All right then. Well, I think we might end it there then. So thank you all very much, and have any questions, by all means, shoot them through the normal Vinlink channels.